Imagine waking up to find your country's largest bank frozen, not by hackers or collapse, but by a foreign government 8,000 miles away. This isn't fiction. It's the warning global banks just got from the U.S. Treasury. If you handle Chinese trades or oil linked to Iran, even if it's paid in yuan, you could lose access to the entire U.S. financial system. But here's the twist. The more Washington tightens its grip, the faster the world is building a system that doesn't rely on it. And the next move is already in play. In April 2025, U.S. Treasury officials met secretly in Hong Kong. They weren't negotiating. They were issuing one of the most aggressive financial ultimatums in decades. According to Bloomberg and CNBC, Washington warned global banks, if you handle oil linked to Iran, especially when it ends up in China, you may lose access to the U.S. financial system. This includes losing access to SWIFT, U.S. dollar clearing, and all U.S.-based intermediaries. But this wasn't just a threat. 2 weeks later, 9 Hong Kong-based entities were sanctioned for allegedly laundering oil revenues linked to Iran's Revolutionary Guard. And here's the kicker. China is importing over 1 million barrels of Iranian oil per day, accounting for 91% of Iran's exports. And most of it? Paid in Chinese yuan. This isn't just about oil, it's about dismantling a rapidly expanding non-dollar trade loop. The risk. The harder Washington squeezes, the more it invites the world to build a financial system that runs without the U.S.'s Hong Kong banks. Caught between superpowers. Hong Kong banks are in the crossfire between two financial superpowers. The U.S. Treasury has told institutions like HSBC and Bank of China Hong Kong to look beyond front companies and identify the ultimate owners involved in Iranian oil trades, especially those transacting in yuan or other non-dollar currencies. These aren't minor players. In Q1 2025, Hong Kong handled over $260 billion in cross-border settlements, with more than 50% now conducted in yuan, surpassing the dollar for the first time. The U.S. is pushing its demands onto foreign banks, essentially making them compliance arms of the U.S. Treasury. But what happens if these banks push back or align with Beijing's financial networks? China's strategic move. The strategic value of Iran's oil to China is much more than just barrels per day. Under the 2021 China-Iran Cooperation Agreement, Beijing secured discounts of 12% below market prices, plus a 6 to 8% risk premium, all paid exclusively in yuan. This isn't just an energy deal, it's a direct challenge to the U.S. dollar's dominance. Trump's sanction threats are pressuring China's state-owned firms, but here's the paradox. Every new sanction Washington imposes only pushes Beijing to double down. In March 2025, China's yuan-based cross-border transactions hit $725 billion, up 22% year over year. Bloomberg reports that the yuan now accounts for 4.13% of global payment value, a record high. This isn't a temporary workaround, it's a prototype for a new financial system. U.S. economic struggles. Imagine you're a foreign manufacturer considering a U.S. expansion. You're sold on the idea of America's massive consumer base, but then the numbers hit. As of April 2025, U.S. consumer sentiment dropped to its second lowest level since records began. The latest report shows 12-month inflation expectations at 5.6%, the highest since 1981. Retail and wholesale profit margins contracted by 1.6% in April, the sharpest decline in over a decade. Companies aren't passing costs to consumers, they're absorbing them, and that's before tariffs. Steel import prices are up 25% year over year, and retail profits have declined in 15 of 17 months since 2023. The U.S. economy? It's not poised for growth. It's running out of slack. What happens when the U.S. consumer market fails? So what happens when the very foundation of reshoring, the strong U.S. consumer, collapses under its own weight? Enter President Trump's One Big Beautiful Bill. It promised to make the 2017 tax cuts permanent, but buried inside is a clause that could have massive global consequences. The bill would authorize retaliatory taxes on foreign countries that impose unfair tax treatment on U.S. firms. But here's the catch. Fairness isn't legally defined, and enforcement is entirely at the White House's discretion. This could mean a 5% tax increase on U.S.-sourced income from foreign companies and a 2.5% hike in withholding taxes on outbound payments. These hikes could reduce foreign direct investment into the U.S. by $91 billion annually. Ironically, the bill intended to attract investment may drive it away. Higher taxes and unpredictable policy swings will create the uncertainty manufacturers fear most. Sanctions and financial volatility. Sanctions aren't precise instruments, they're more like dynamite. The U.S. Treasury's secondary sanctions against banks involved in Iranian oil trade could push them to lose access to dollar clearing. But the result? It's accelerating the trend of the world moving away from the dollar. In March 2025, renminbi transactions hit $724.9 billion, accounting for 54.3% of China's global trade, up from just 36% in 2022. The yuan is now the fourth most used global currency, with a 4.13% share in payment value, a record high. China is making moves to insulate itself from the U.S.-dominated financial system.
Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.